Well, thank you, Amy, and thank you to everyone for joining us. Welcome to our fall nonprofit audit and accounting update. As Amy mentioned, my name is Stacy Nelson. I am a partner in our Sioux Falls, South Dakota office, and joining me today is Alyssa Blommel, a manager in Minneapolis. So today, accounting and auditing update. We have a few items here on our agenda we're going to discuss. We're going to start off and talk about contributed non-financial assets, or those gifts in kind. We're also then going to touch base with some of the lease standard with some of the nuances relating to nonprofits and leases. We're then going to move into current expected credit losses, commonly referred to as CECL, and we'll wrap it up with just a few other relevant standards. So these are those items that the accounting standard updates for the year that we considered to be the most applicable to our nonprofit friends. So with that, let's go ahead and jump right into contributed non-financial assets. So current GAAP, prior to this amendment, didn't include specific presentation requirements for those contributed non-financial assets or any specific disclosure requirements. So with the standard, the objective was to increase transparency about those contributed non-financial assets for all nonprofits. So when we think about kind of the why behind the standard, the value of those gifts in kind can have a significant impact on the key metrics to nonprofits. For example, your program service expenses. Those items may also have implications for the programmatic and financial sustainability of the organization. So what is a contributed non-financial asset? It could be things such as fixed assets that have been donated. It may be the use of fixed assets. So if you get donated building space or leased property for no charge. Could be materials and supplies as well as intangibles. Commonly, we see professional services as well being an item that is donated to nonprofits. So this amendment does not create any new recognition or measurement requirements. So as far as which of those contributed non-financial assets would fall under recognition criteria, there's nothing that has changed there. We're just really providing some more transparency in those amounts and additional disclosures. So that being said, presentation requirements. In the statement of activities, if you currently are not breaking out your gifts in kind on a separate line item, you will now be required to present them separately from other contributions. As far as disclosures, we're going to have some additional information there that's required, some qualitative information about whether those contributed non-financial assets were either monetized, meaning sold, or if they were utilized during the reporting period. You would want to include information about your organization's policy, if any, about whether you are monetizing any of those contributed non-financial assets. You will include a description of any donor-imposed restrictions, as well as a description of any valuation techniques. So how did you arrive at that fair value of those contributions? You will include information about the principal market or the most advantageous market used to arrive at fair value. So if we think about that, what does that mean? What is the most advantageous market? That would be the market that maximizes the amount that would be received to sell the asset after taking into consideration any potential transaction costs or transportation costs. The principal market then would be the market that has the greatest volume and level of activity for that particular asset. So let's take a look at then what that might look like as far as presentation. Here is one example of the gifts in kind, how they may be presented in your financial statements. So you can see in this particular example, the statement of activities is a columnar format. So the first column has your activity without donor restrictions, and then the second column is with donor restrictions. So in this example, what they have done is they have added underneath contributions, we have two sublines. We have one line for the cash and other financial assets that have been received, and then we have added an additional line to capture the information related to those gifts in kind specifically. So this particular example, they had 548,140 of gifts in kind without donor restrictions and 20,000 with donor restrictions. Here is an alternate presentation. So again, it's a columnar format, but rather than adding a separate line item, this presentation is adding a separate column. So they've added a separate column for contributions in kind, and you've got all of your other contributions, revenue support and gains to get to your total. So this might be a beneficial presentation if you have an organization that receives a significant amount of gifts in kind. In this example here, you can see, as I mentioned earlier, it's a 548,000 of in-kind donations. Though that would be the portion relating to the without donor restrictions of their total support for without donor restrictions of 765,000. So a substantial amount of their support is coming from those gifts in kind. So this presentation may be beneficial to break that out in that format. There's no prescribed format. You can use either as long as it's separately stated in your statement of activities. As we move on then to disclosure, what do those disclosures look like? In this particular example we have here, this is a tabular example. So you've got all the information kind of put together in a table. The first column there, you've got a description of what those gifts in kind are. The second column is the amount. We've included amount in this third column here, usage and program activities. So are they being used for all activities or a specific program? The next column includes information about any donor imposed restrictions. And then the last column is those valuation techniques and inputs. An alternative presentation would be to include that information in more of a narrative example. So in this particular example, we still have a small table that gives us a description of what those gifts in kind are, as well as the dollar amounts. But the other information is being presented in a narrative format. So the gift in kind valuation techniques and inputs, for instance, for the building, that's being estimated on the basis of comparable sales prices in the real estate market of the metropolitan area in which the building is located. So it's talking about how that value was arrived at and what market it was based on. The supplies and food items, those are being valued at estimated fair value on the basis of estimates of wholesale values that would be received for selling similar products. So again, how they're determining the value. Donor restrictions, in this particular example, there was no gift in kind that was restricted except for 20,000 of those veterinary supplies. That's for use in one of their specific programs. It's talking about the organization does not sell donated gifts in kind, it only distributes those goods for program use. So covering kind of all those things we talked about before as far as required disclosures. What would be an example of a monetization? We have that here on our next slide. In this particular example, the entity received vehicles donated to its organization. So it's their policy to sell all those contributed vehicles immediately upon receipt at an auction or for salvage, unless that vehicle is restricted for a specific use. So in this example, no vehicles received during the year were restricted, and all of their vehicles were sold and valued according to the actual cash proceeds that they received on the disposition. So that's an example of what that monetization might look like. For services, how might that be disclosed? In this case, we have veterinary services that have been received. And as I mentioned earlier, the standard did not change the recognition criteria. So you're going to follow the same criteria you had before as far as recognition and measurement. So they have received contributed veterinary services to provide care and treatment to animals under the care of the shelter. Those services have been valued and reported at the estimated fair value in the financial statements, and that's based on current rates for similar services. In this case, they have provided or opted to provide additional disclosure about additional contributed services that were received but not recognized. So as we mentioned, you would only recognize those services that require a specialized skill. So they've also received approximately 13,000 hours of contributed volunteer services that did not meet the criteria for recognition. But they felt it was still important enough for the readers of the financial statements to know that in addition to the amounts that were recognized, they received these additional donated time. And that is important to know because, for instance, if they were not, did not receive that volunteer time, they may have to pay someone or maybe wouldn't be able to provide as many services or mission if they did not have those volunteer hours. An example of a disclosure relating to principal market with restrictions is included here. So this refers specifically to the veterinary medicine. The contributed veterinary medicine was restricted by the donor, as we saw on that first slide, 20,000 of it, that it had to be used outside the United States for a specific animal rescue operations. Their techniques to value that is kind of twofold. A portion of those medicines are being valued. The portion that is legally permissible for sale in the United States is being valued based on this published article that approximates wholesale drug prices in the United States. So that would be its principal market. The other part of it are medicines that are not permissible for sale in the United States. Maybe they haven't passed certain inspections or approvals, and as such, they are using third-party sources, which represent the wholesale exit prices for those. So maybe a little more narrow in scope, probably not something you'll have very often. However, if your nonprofit maybe is receiving pharmaceuticals or something of that nature, this may be beneficial for you to have as an example to disclose those types of values. So that kind of wraps up the first section here relating to the gifts in kind or the contributed non-financial assets. And next, I'm going to turn it over to Alyssa to talk about leases.
Thank you, Stacy. And we did have one question come across. I don't know if you want to go through that quick or.
I will take a look at it while you get started.
All right. So the topic that I feel like we've been hearing about for a long time is leases. It's been around for a while, and it will be effective for most nonprofit organizations this fiscal year. So we're going to cover some of the key points of the standard and discuss some nonprofit specific considerations. There are a lot of nuances with the adoption of the standard, and we will just be hitting the tip of the iceberg in the discussions here, and a handout will be provided to follow up email that will give you the tools to get started. The applicable date for ASSI 842 for public not-for-profit entities was for fiscal years after December 15th, 2019, and for all others, it is fiscal years beginning after December 15th, 2021. This next slide shows some practical, Stacy, if you can, there we go. Practical steps for implementing the lease accounting under the new standard, starting with review of the lease contracts, defining the period in payments, determine the discount rates, evaluate the classification of the lease, and assess transition elections. On the next few slides, we'll walk through these steps in more detail. Identifying lease contracts isn't always as simple as it sounds. A good place to start is to gather the known and potential contracts for review. Take a look at the rent or lease expense or other accounts where these items might be recorded, and review for recurring vendor payments or vendors that you have contracts with that could have a lease included. Figure out if the contracts include more than one lease. Maybe you have an office space and equipment lease in one contract to segregate lease and non-lease components. For example, common areas that are shared by multiple lessees if you lease office space, or use service contracts for embedded leases. Next, we'll discuss lease periods and payments. The lease period is the non-cancelable period for which a lessee has the right to use an underlying asset. This also must take into consideration any options to extend or terminate by the lessor or the lessee. For lease payments, it would include items like the types of payments, for example, fixed or escalating, any residual value guarantees, non-refundable deposits, prepayments, lease incentives, termination costs, purchase options, and initial direct costs. From here, your organizations can make some decisions and estimate residual value guarantees costs based on projected use. Determine reasonable certainty of purchase and termination costs, and evaluate if you can combine certain leases, such as land or easements, with a building lease. I also wanted to note that variable payments not dependent on an index or rate, such as a percentage of sales, are not considered part of the lease payment and are a period expense in the period the target is achieved. If payments based on sales volume has a floor payment, the floor would be considered part of the lease payment. Determining the discount rate will vary by lease. Some leases, well, this is pretty rare likely, have an implicit rate under the lease. If this is determinable, it is required to be used. Otherwise, use of an incremental borrowing rate or the risk-free rate can be used for eligible organizations. Incremental borrowing can be obtained by reaching out to lessors to ask what the rate would be or is for similar terms, or it could be a current borrowing rate held by your organization for another contract with similar terms. Use of the risk-free rate is simple, but since it is a lower rate, it will result in a higher liability. At the end of the day, documentation will be important for this. Make the decision and document how and why the rate was determined to be reasonable by your organization to determine and to support the estimated calculations that come from the use of the discount rate. Next here, we've got lease classification. This is different under the new lease standard, but it is a similar concept. The new terminology for lessees is operating versus financing. Here we've listed some common considerations to determine if a lease is a financing lease. Your organization has taken into consideration if ownership transfers by the end of the lease term. Is there an option to purchase that is reasonably certain? Is the lease term a major part of the remaining economic life of the underlying asset? And reasonable guideline for that is 75%. Present value of a lease is equal to or exceeds substantially all of the fair value of the underlying asset. And for this, a reasonable guideline is about 90%. And then is the underlying asset specialized in nature? In other words, is it expected to have no alternative use at the end of the lease term? And here we've got a few transition elections, and there are some practical expedients to lease standards, and they do need to be elected collectively, so you have to apply it to all your contracts that are determined to be leases. This includes the option to retrospectively apply to each period reporting year with a cumulative effect recognized at the beginning of the earliest period presented, or retrospective for each period presented, resulting in a cumulative effect adjustment through retained earnings. Some other items include that you do not need to reassess whether expired or existing contracts contain leases. Lease classification doesn't have to change, so operating would still be operating and capital will now be financing for any leases that were existing. An organization also does not need to reassess initial direct costs for existing leases. Your organization can use hindsight in determining renewals, terminations, or purchase options and land easements not previously classified as leases do not need to be reassessed. Some specific nonprofit considerations that we wanted to bring to your attention are include noting that a contribution is not a lease. A lease is a contract that conveys the right to control the use of identified property, plant, or equipment. Think of it as an identified asset for your period of time in exchange for consideration. Meaning, if you do not have to give anything in return, it is not a lease. An unconditional promise to give the use of a long-lived asset like office space or a building conveys the right to control the use of identified property for a specified period, and the donor retains legal title and collects no lease payments. This flows to our next slide for below market leases. When a lease agreement's payments are below fair rental value of the property, there may be a partial donation from an inherent contribution. The fair value of these contributions is excluded from the calculation for the right of use asset and lease liabilities. The next slides walk through an example of what this looks like. In this example, a donor provides a nonprofit with discounted use of equipment for 3 years, beginning on January 1 with the terms listed below. There are no options for renewal or transfer of ownership, and the economic life of the equipment is 3 years at a below market rate of $15,000 per year. For this example, the fair value of the total rental is calculated at $100,000 over the lease term. The consideration of $15,000 per year and is recorded using lease accounting, and the difference between the fair value and consideration paid will be recorded using contribution accounting. On this next slide here is a summarized calculation of this transaction, showing the total value for use at $31,000 for year 1, $33,000 for year 2, and $36,000 for year 3 for the total of $100,000. Consideration or lease portion at $15,000 per year or $45,000 in total, and the contribution, which is the difference between the fair value and the consideration of $55,000 for the contract period. These amounts are then discounted to the present value and reported as a right-of-use asset and a lease liability for $41,600 and a contribution of $52,700 to be amortized over the life of the contract as shown on the next slide. Summarized on this slide is a reconciliation of the contract for each year of the contract and what the adjustments and year-end values would be, showing the values at the beginning and end of each year for the changes for like the amortization, lease payments, and in-kind contributions as applicable for each part of the calculation. And the next slide walks through the entries to record the transactions. Here it shows that you initially record the right-of-use asset and offsetting lease liability, along with the promise to give, which is recorded as a restricted in-kind contribution due to the time restriction from the donor under the contract. Annually, the right-of-use asset is reduced by the calculated amortization. The lease liability is reduced by the present value amount of the lease liability with offset to amortization or interest expense for the difference in the cash paid and present value calculations. The promise to give is reduced in a similar way by removing the calculated present value for the year and the amortization of the discount, which is equal to the in-kind rent expense. The last adjustment here shown is using the $16,000 from the in-kind rent expense to release the donor restricted net assets. This final slide on leases discusses a fully discounted lease and explains that when no consideration is paid, the lease accounting is not followed and contribution accounting is. In the example shown here, the fair value of the rent is calculated as $69,000 for $20,000 in year 1, $22,000 in year 2, and $26,000 in year 3, discounted at 5% to $62,370. The transaction is recorded as a donor restricted net assets to the time restriction for use in future periods. And with that, I will hand it back over to Stacy.
All right. Our next topic is credit losses. So this is a standard that was put out in 2016, and it relates to current expected credit losses. At first glance, a lot of people, I think, believe this relates to the banking or the finance industry. And how would that relate necessarily to a nonprofit organization? So we're going to look at that today. Our goal is to kind of analyze the changes that will occur as a result of these upcoming CECL accounting standard updates to give you some information on the topic and help you to have an understanding of the impact on nonprofits, have a takeaway of how that may affect your organization, and what things you should be doing to evaluate the standard in advance of adoption. So this standard is now going to require more timely reporting and disclosure of those credit loss allowances on receivables and other financial instruments that aren't currently reported at fair value. So the biggest takeaway is that we're moving away from an incurred loss method to an expected loss method. And those expected losses are going to be based on historical experience, but also we're going to take into consideration current conditions and reasonable supportable forecasts. So the objectives are to eliminate the barrier to timely recognition of those credit losses. It's going to require the entity to recognize that allowance of those lifetime losses. The standard you'll see does not require a specific method on how you are using to estimate those credit losses. It provides you with some flexibility. So that's the good news. The effective date for the standard is for annual periods beginning after December 15th, 2022. So for a calendar year end, it's going to be 2023 calendar year end. If you are an off calendar year end, such as a June 30 or a September 30, it will be for fiscal year end 2024. Early adoption of the standard is permitted. However, we don't anticipate that many will take advantage of that. So what type of accounts will be impacted by this standard? So this standard will be effective or applicable for any financing receivables. So this could be notes receivable. Maybe you have an entity maybe you have notes receivable with an entity for services you either have provided or are currently providing. It's going to relate to any contract receivables. So those receivables arising from topic 606, trade receivables. If your entity has maybe merchandise sales, tuition income, service fee income, or membership dues, these would all be contract receivables that would fall under the new standard. Any receivables for topic 860, which is repurchase and securities lending agreements, may be a little more narrow in scope. But if you have a nonprofit that maybe purchases a loan portfolio from another entity, or you're servicing the loan portfolio of another entity, that would be applicable under this topic. Held to maturity is also included in the standard. However, it's not really applicable for nonprofits. Net investments in leases. So lease receivables, we just talked about leases. Lease receivables recognized by a lessor arising from either a sales type or a direct financing lease. Those would be covered under the standard. Any programmatic loans, maybe some unique characteristics that don't exist in the banking world is if you have a nonprofit that is making either a seed money loan to support a new performing arts organization or a low interest loan to a community development foundation, those type of financial assets may have loan forgiveness, which you wouldn't typically have in the for-profit banking world. So what is the expectation of payment relating to those? The last item then on this slide is off-balance sheet credit exposures. So if you have guarantees of another entity's debt, or maybe you have some loan commitments, those are also going to be scoped in under this topic. So now that we've figured out what types of things are included, what are items that would not be included within the CECL standard? So promises to give have been specifically exempted from the standard. So any of your contributions receivable, this will not be applicable to. If you have financial assets that are currently reported at fair value and those changes are being reported through net income, those are excluded. Any participant loans that are made through defined contribution benefit plans are not included. If you have intercompany loans and receivables or those between entities under common control, those are excluded, as well as any derivatives and hedging instruments that fall within the topic scope of topic 815. So I mentioned on the previous slide that those sales type and direct financing leases under a lessor are included. That being said, any receivables arising from an operating lease are also excluded. So main provisions, unlike the current incurred loss models existing in US GAAP, this new CECL model does not specify a threshold for recognizing an impairment allowance. Rather, an entity will recognize its estimate of those losses for financial assets as of the end of the reporting period. So credit impairment will be recognized as an allowance or a contra asset rather than a direct write-down of the amortized cost basis of the financial asset. So financial assets or groups of financial assets will be measured at the amortized cost and presented at the net amount expected to be collected. The expected credit losses are included in that change in net assets. And we're going to look at those estimated losses over the contractual term of the financial asset. So we're going to consider more than just the historical information. We might have current information, which is can be either internal or external information. For example, we might be looking at the organization's environment. If we look to the current conditions today, as an example, does the entity have decreased demand for their services? Do they have supply chain issues that may affect their ability to pay their receivables? Other factors that might be specific, does the entity have they had turnover in management, or are they experiencing cash flow issues? Do we anticipate that maybe they'll have prepayment, that they'll pay off those receivables early? So that would be some examples of current conditions. Now, as we look to reasonable and supportable forecasts, what does that mean? How are we going to determine what the crystal ball of what is to happen in the future? So organizations aren't going to be required to perform an exhaustive search. You're going to look to that information that's reasonably available without any undue cost or effort. That being said, you want to make sure you're not ignoring any relevant information. We will look at kind of some of the estimation methods in more detail coming up. So measurement, we're going to record that allowance for credit losses on financial assets and report in change in net assets as a credit loss expense. That amount necessary to adjust the allowance for credit losses for management's current estimate of that expected credit losses on the financial assets. If a group of financial assets share similar risk characteristics, then entities can estimate that credit losses on a collective or pool basis. So while those provisions allow the assessment of asset groups, management also should periodically evaluate those groups, needing to determine if any of those individual items should be shifted to another group, or potentially they should be evaluated individually based on changes in circumstances or risk characteristics. As I mentioned, there's a number of methods that can be used. Some of them are listed on the slide here off to the right. We'll get into a little bit more information on each of those methods in the next slide. So that was how you would record at the initial measurement, the reporting date. Subsequent then to that initial reporting date, you're going to go through a similar process. You're going to do that analysis of your expected credit losses, and you're going to record an allowance and compare that to your current estimate, compare your current estimate with your prior one. So that adjustment necessary to achieve the appropriate allowance is going to flow through change in net assets for each reporting period. So organizations are going to report that amount needed to adjust the allowance to reflect your current estimate of the expected credit loss. And this will be reported as either a current year credit loss expense, or potentially you could have a reversal of a credit loss if you have seen conditions that have improved over the prior year. So ways to measure the expected credit losses. FASB, when they were putting together the standard, believes that the impairment allowance should reflect management's expectations regarding the net amounts expected to be collected, and that various entities manage risk differently. As a result, you should have flexibility in determining and calculating those credit losses. So they don't require any specific method. They provide a variety of methods that you can use. So in looking at those, the first one here being the discounted cash flow method. This would be a discounted cash flow model to estimate expected future cash flows, and you would record the appropriate loan loss reserves. For example, you might have cash flows that are being projected by month, and another where a loss factor is applied to that overall contractual cash flows, which is often a modified version of the monthly projected cash flow model. The loss rate method will probably look a little familiar. It's related to those entities that have currently aging of receivables. The loss rate methods can take various forms, but a common thread is that they're based on historical rates of loss. So an organization would estimate future credit losses by using the percentage of receivables that have historically gone bad, and then make any necessary adjustments based on that relevant information around current or future conditions. Roll rate methods, that's often referred to as either a migration analysis or a flow model, and is based on determining a prediction of credit losses, breaking them into segmentation of the portfolio of financial assets. So an example of that segmentation might be delinquency or risk rating. The probability of default method. Under this model, an organization will, for a pool of loans, make two estimates. First, the first estimate will be the probability of a default, which is the likelihood that a default event will occur to either an asset or a pool of assets. Secondly, then they're going to estimate the amount of loss given that default, which would be the magnitude of the loss. The last method here then is the aging schedule method. Again, you're going to pool your receivables that either have similar risk characteristics and consider whether historical loss rates need to be adjusted for asset-specific characteristics. You know, do you have a difference in the portfolio mix? And you're going to adjust that historical loss rate for any current conditions and reasonable supportable forecast. So we'll look at an example of what this might, how this might be calculated. The standard really emphasizes that the entity should use the method that is practical and relevant given the specific facts and circumstances, and that the method used to estimate those losses could vary depending on the type of financial asset. So the entity might use a different method for their trade receivables than they do for loans receivable potentially. So you'll look at both the ability to predict that timing of cash flows and the information that is available to you in order to make those estimates. So our first example here, we have ABC nonprofit. They have $30 million in trade receivables. Under prior GAAP, that allowance was calculated to be $3 million and was based on an aging at period end using a historical loss rate. So they had put those in buckets by aging, and those loss rates ranged from 0% up to 90% for those items in buckets greater than 90 days. So in applying that historically under current GAAP, they had a credit loss expectation of $3 million. Management believes that that historical loss information was a reasonable basis on which to determine those expected credit losses because the composition of those trade receivables was consistent with that was used in developing the historical credit loss percentages. So there wasn't a lot of change in the types of financial assets that they had year over year. Some of those pooled assets had similar risk characteristics by customers and lending practices, and those had not changed significantly over time. However, management has determined that current reasonable and supportable forecasted economic conditions have deteriorated as compared with the historical information. So in this case, they're specifically looking at the unemployment rate, which has increased as of the current reporting date. And management expects that there will be an additional increase in unemployment over the next 18 months. So based on its past experience for similar increases in the unemployment rate, management adjusts its historical loss rates to reflect the differences in current conditions and forecasted changes for an increase in its allowance of $3.4 million. So they took those historical loss rates and increased them for what they anticipate to be the effect of those change in the unemployment rates. So CECL requires that a credit loss be recorded for expected losses, even with that receivable is current. So if you haven't yet experienced any past due amounts, and you may expect full recovery for an individual customer on a portfolio pool level, some loss would generally still be expected. So that risk of loss needs to be reflected in that allowance, even if that risk is remote. Excuse me. So that's one example of how that credit loss would be calculated. Here we have another example. In this case, we have economic development entity, and they make loans to small businesses. The borrower mix is consistent, so that credit risk characteristics are consistent across that pool of loans. They also have determined that their best economic indicator that correlates to past bad debt expense is related to unemployment rate, which in this case has improved. So as a result, economic conditions are more favorable than they previously were, and they're expected to continue to drop or continue to improve. So historically, those historical loss rates have ranged from 0.10% to 8%. Applying their best estimate of that effect of the unemployment rate, they're showing a 10% adjustment to those historical loss rates, which when applied to the historical rates, brings them to a range of 0.9% to 7.2%. So they concluded that it's reasonable and supportable that the current expected loss rate will improve over the life of its loans receivable. And they are going to adjust their historical accounts by reducing or improving it by that 10% for each age category. So applying that to their loan portfolio of $1 million, they have calculated an allowance of $21,420. So disclosures, what type of disclosures are going to be required as a result of the standard? So the objective of the disclosures is to enable a user of the financial statements to understand the credit risk inherent in that portfolio. And how is management monitoring that credit quality? What is their estimate of the credit losses and changes in those credit losses that have taken place during the reporting period? Specifically, disclosures are going to require information about the accounting policies and policy elections for each of those classes of financing receivables, credit quality information, which is going to include a description of that credit quality indicator. Do they have any amortized cost basis, date, or range of dates in which that information was last updated? It's going to include a roll forward of that allowance for credit losses. So what was the beginning of the period balance or the beginning of the period estimate for credit losses? Current year effect, was that an additional credit loss or was it a recovery of credit losses? And then to get to your final end of the year estimate for allowance for credit losses. You will include information about past due status. That might be aging analysis. You would disaggregate that by class and disclose, when does the organization consider something to be past due? Items relating to that are at a non-accrual status. That would include the beginning and ending amortized cost basis, any interest that had been recognized on those non-accrual items. If you have collateral dependent financial assets, so in our example of a loan portfolio, if that loan receivable has collateral for maybe the underlying building for which it was used to purchase, you would include disclosures if you expected repayment to be satisfied through either operation or sale of that collateral, and whether the borrower is experiencing any financial difficulty. Off-balance sheet credit exposures, as we talked about earlier, that was those loan guarantees or loan commitments. Previously, under previous GAAP, you only had disclosure in the notes if you had a loan guarantee. But now under CECL, you would need to estimate the amount that you anticipate that you may have to fulfill relating to that guarantee, and you would record an actual liability or an expected loss. So the financial statement presentation for those financial assets that are measured at amortized cost, including loans, trade, and lease receivables, on the balance sheet, those will be presented at the amortized cost. The balance sheet, the allowance, will be presented separately from the assets amortized cost balance. And the effect on the income statement then would be those expected credit losses will be presented as a credit loss expense. In the case of those loan commitments or other off-balance sheet instruments, again, there would be no balance sheet effect, asset balance effect, because there is no recognized financial instrument, but you would have a liability reported, and any liabilities relating to those loan commitments or off-balance sheet instruments would not be included with those other credit losses. They would really be reported separately as an expected credit loss. And then similarly, that credit loss in the income statement would also be shown as credit loss expense. So what are our next steps related to credit losses? You are going to want to take inventory of the financial assets your organization has and try to determine if they are going to fall under CECL. You're going to consider those sources of internal and external factors to be used to make those future projections. If you have those assets, begin to think about what potential impairment might be under those expected loss models. You'll determine the level of detail needed to meet disclosure requirements, as well as how you're going to disaggregate information needed into each of those classes. As we mentioned, there's a number of methods for calculating those credit losses. Have to choose the method that's most appropriate, given the information you have available and the ease with which you can make that calculation. So you may have to develop policies, procedures, or change your internal controls over those CECL estimates. This standard is still fairly new, so look for more information to be forthcoming, throughout the year as we get closer to the actual implementation date. So with that, I'm going to turn it back over to Alyssa to walk us through some other standards.
Yeah, there are a few other standards we just wanted to bring to your attention, and they're shown on these next few slides. ASU 2018-15 relates to intangibles, goodwill, and other internal use software. It allows the implementation cost of the development stage to be capitalized and is effective for public business entities for fiscal years beginning after December 15th, 2019, and for all other entities after December 15th, 2020. So there's that one. The next slide, it talks about ASU 2017-14, and this covers goodwill impairment by simplifying the test and eliminating step 2 of the goodwill impairment test. The focus is on the lower fair value compared to the carrying value of the reporting unit. Negative goodwill is not recognized, and this standard is effective for public business entities with fiscal years beginning after December 15th, 2020, and for all others beginning after December 15th, 2021, and early adoption is permitted for this standard. 2021-03 is also covering goodwill impairment, and this one allows the organization to perform goodwill impairment triggering event analysis as the end of the reporting period, whether that be impairment interim or annual. This applies only to private entities and nonprofits, and this just kind of simplifies it so you don't have to take a look at events during the year to consider if, maybe impairment would have been met in July, but at year end in December, things have recovered, so then you wouldn't have had to take that into consideration. And then also, if that alternative is selected, like I said before, it doesn't require the monitoring for impairment triggering events during the reporting period, and facts and circumstances are instead evaluated at the end of each reporting period. If goodwill is not amortized, the annual impairment test is performed as of a date other than the annual reporting date. You should perform a triggering event evaluation as of the end of the reporting period. This slide talks through some of the other requirements, including that the standard is adopted on a prospective basis and that early adoption is permitted. This one, is only available to private entities, not profits, and it should not retroactively adopt the amendments for interim financial statements already issued in the year of adoption. And then ASU 2020-04.
This one's fine.
That one's yours? Okay, sorry.
Yep, no, you're fine. So this relates to reference rate reform. And this kind of came about from a change in this London interbank offered rate, which is often referred to as LIBOR, which is going to be phased out by June 30th of 2023. So there's a number of instruments, contracts, maybe leases that relate back or refer back to this LIBOR rate. And as such, they wanted to provide some guidance what should be done as far as a change in this reference rate from the LIBOR to a new reference rate. So US GAAP normally requires the reassessment of any contracts when those terms are changed. And that's to determine if those modifications result in the establishment of a new contract or if you have continuation of an existing contract. So this standard provides some practical expedients and exceptions for applying that GAAP assessment to these affected contracts. As I mentioned, it could be contracts, leases, it may be hedging relationships or other transactions. So these practical expedients only apply to modifications that replace one of those benchmarks, a benchmark reference rate that is affected by reference rate reform. The general principle is to not require remeasurement at that modification date or reassessment of previous accounting determination. There are optional expedients, and those must be applied for all eligible transactions or contracts. So you cannot pick and choose which contracts you want to apply it to. The next one, 2020-101, also relates to reference rate reform. So closely related to the previous one. It clarifies that certain optional expedients and exceptions in that standard apply to derivatives that are affected by discounting transition. So it applies to those derivative instruments that use an interest rate for either margining, discounting, or the contract price alignment that is modified as a result of that reference rate reform. So those two standards, the first standard is effective March 12th of 2020 through any modifications that were made through December 31st of 2022. The second standard was effective upon its issuance, and it clarified essentially that those amendments do not apply to transactions that are occurring after that December 31, 22 date. So any contract modifications made after December 31st, 22, or hedging relationships entered into, or any existing hedging relationships evaluated for effectiveness in periods, again, after that date. So those two standards go hand in hand. And with that, that kind of completes the standards that we had covered today. So we'll take a look here at some of the questions and see if we can answer those. So one of the first questions here is asks, do we still follow the rule that if a donor does not give any documentation for the fair market value of the donated item, we as the organization cannot give it a value? And I would go back and say, refer back that the recognition and measurement rules do not change under this gift in kind standard. Really, you would still look to the old rules, and typically, it's going to depend on what that donated item is, obviously, and materiality also always plays a factor. So just because the donor doesn't provide you a value doesn't necessarily mean there is no value. You may have to do a little due diligence on your end. Maybe it could be as simple as a Google search potentially for what the value of that item is. Let's see. Another question, under what circumstances, if any, would a license to use software fall under these lease rules? So there you're going to need to take a close look at your agreement to determine if you have an actual lease or if you have more of a hosting services are being provided. There is guidance, I believe. Was that one of the ones? Let's see here. I don't have these all memorized, but there is a standard. So here, this would be a good example of where you would want to look back at this standard, where you have implementation costs incurred in a cloud computing arrangement that is a service contract. So you would want to look, potentially your licenses fall under that service contract or hosting arrangement rather than an actual lease. So there are some specific rules that you would want to follow under that standard to walk you through each of those stages and help you identify which it might fall under. Another question here asking if you would send a donation letter for the amount of the below market lease amount. Certainly that would depend on what your current gift acceptance policy is. If you are sending letters for all of your donations, you likely would want to send that one for that as well to be consistent. You would also want to make sure you are documenting how you determined what that market lease amount was, to how you arrived at that amount that was the donation or the contribution versus the portion that was actually lease expense. Another question here, what is the time frame to be considered of a historic trend? 2 years, 3 years, more? I think that's open for judgment. Typically, I think you would, depending on the history of your organization as well, you may only have 2 years of history, you might have more. And that being considered, what are the current events versus what they were 2 or 3 years ago. We've just come through a very significant event in our history with COVID, and that obviously is not going to be what we expect each year going forward. So that will be in your history, but maybe that's an outlier. So it's open to judgment. There's nothing specific that defines, what would be considered a historical trend. We would just recommend that you kind of establish that for your organization and document what you used as a historical range. Another question here, what would be a goodwill triggering event? So for example, if you have an organization, and depending what your goodwill is, say it's maybe it's a client list or a client list for services that you're providing, and maybe a triggering event is that the software, or not software, maybe the goods and services that you are selling, there's now, what's the word I'm trying to think of? Oh, good grief. There has been results or improvements, and that particular product is no longer maybe valuable because there's something that's better out there that would be used in an example. That would trigger maybe the value of that goodwill. That could be an example of a triggering event. Another question here about the slide deck, and that should be down available in the chat. If not, it will be sent out following today's session as well. as well as potentially any other questions that we did not get answered today will be sent out. An email responded directly to you. Let me get back to my slides here. Want to thank you for your time today. I also wanted to point out that we do have one more nonprofit webinar before year end, and that relates to nonprofit considerations for international projects and remote workers. And that's going to be on Monday, December 12th at 1 p.m. Central Standard Time. You can join us to discuss tax considerations for nonprofits that are engaging in international projects and contracting with or employing individuals outside of the US. So if that's something that is of interest to you, I invite you to go out to our website and get signed up for that session. With that, if there are no other questions, we will adjourn for today. I want to thank you for your time and wish you all a very Merry Christmas.